Crypto revenue collapsed 38% year over year, and the stock is still cruising, which tells you everything about how the market now sees this business. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Robinhood Markets, ticker HOOD, for the second quarter 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk and your results may vary. Alright, revenue came in 8.10% above the estimate and up 32% year over year to a record $1.31 billion. Transaction revenue jumped 44%. And event contracts were up more than 10 times year over year. That is a real, clean top-line beat. And on EPS, the reported number was 51.22% above the estimate. But here's the catch. About 14 cents of that came from a one-time gain on deconsolidating their ventures fund. Strip that out, and the clean operational EPS was closer to 48 cents, which is still up meaningfully from 42 cents last year, just nowhere near the headline pop. So on the beat itself, and remember, I'm grading against the clean numbers, not the one-time gain-inflated headline, this still earns an A. An 8% revenue beat combined with a solid operational EPS beat, powered by transaction revenue up 44%, is a genuinely strong print. On consistency, this earns a C. Robinhood has a mixed multi-quarter track record of beating, and the crypto line specifically has been lumpy enough that you can't call these results predictable yet. Top line grew 32% year over year to a record $1.31 billion. Transaction revenue was up 44%, and event contracts alone went up more than 10 times year over year. That is a lot of engines all firing at once. And on top of that, they now have 13 separate business lines each, doing over $100 million in annualized revenue. The credit card and their Legend platform both crossed that line this quarter. This is no longer a one-product story. Gold subscribers hit 4.8 million, up 39% year over year, and average revenue per user climbed 24% to $187. So they're not just adding people, they're monetizing each one better. They added nearly 1 million funded customers this quarter, which is the biggest quarterly add since they went public, and 40% of those new customers signed up for Gold right out of the gate. And the profitability picture is the impressive part. Adjusted EBITDA margin hit 57%. And the CFO said they're operating above what's called the Rule of 80, which is basically revenue growth plus margin, and they're doing it at over $5 billion in annual revenue. So on profitability, this earns an A. A 57% EBITDA margin at this revenue scale, combined with operating leverage clearly expanding, is about as good as it gets for a company still growing this fast. Crypto revenue was down 38% year over year, and the CFO said on the call that July activity is trending a little bit slower than the Q2 average. So the crypto drag is carrying into the third quarter. And like I mentioned earlier, about 14 cents of the reported EPS came from a one-time gain on deconsolidating their ventures fund. That's not repeatable, so anyone modeling next quarter needs to work off the clean 48-cent number. July net deposits are tracking toward $4 billion, which is the lowest monthly pace of the year. Management called it seasonal, but for anyone selling premium, that sequential softening after a record quarter is worth keeping in mind. Operating expenses grew 33% year over year, roughly matching revenue. Operations expenses specifically were up 97%, and credit loss provisions doubled. The margin story looks great at the EBITDA line, but the raw expense growth is running hot. And cash sweep balances dropped 9% year over year after a program shift back in February. That restructures how they earn net interest, which is why net interest income only grew 9%, while total revenue was up 32%. On guidance, this lands at an A. Management lowered and tightened full-year expense guidance while absorbing costs from 2 new acquisitions. That's a meaningful operating leverage signal, and it's the strongest possible message they could send. And on red flags, I'm at a C. The crypto weakness carrying into July, the one-time gain inflating headline EPS, and the deposit deceleration are all real concerns. None of them break the thesis, but they're enough to keep me honest. Putting it all together, this was a genuinely strong print that validates the multi-product story that's been the bull case for 2 years. The clean numbers are still very good even after backing out the one-time gain, and management tightening expense guidance is the kind of signal you don't get from a company that's uncertain about the year ahead. The crypto weakness and July deposit slowdown are real, but they don't break anything, so I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. Look, shares already ran hard into this print, and the company itself was buying back around $94 this quarter. Chasing the pop right now is the wrong move for me, because implied volatility collapses fast and takes the premium with it. So instead of buying shares outright, I'd rather sell cash-secured puts on any drift lower after earnings, with strikes sitting about 10 to 15% below where the stock trades now. That gives me room for the diversification story to keep playing out. And if shares hold above the pre-print level for a solid 2 weeks, that tells me the market is repricing this as a real diversified fintech, not just a crypto proxy. That's when I'd move faster on getting my full position on. For me, this is a sell puts on the dip setup, not a chase the rip setup. The multi-product flywheel and that 57% adjusted EBITDA margin let me get a little tighter with my strike selection than I would on a pure broker name. The business just isn't as fragile as it used to be. That said, crypto revenue was down 38% year over year, and July net deposits are trending softer. So I want a floor around 15 to 20% below current price. That's the level where my longer-term thesis still holds up in a broad tech drawdown. I'd stick to 30 to 45 days to expiration rather than weeklies, because management flagged real catalysts between now and then, and I want to be in the trade when that news flow hits, and I only sell closer strikes if I actually want the shares. Tighter strikes are fine, but only on levels I'd genuinely be happy to own. For me, this print really validated the whole thesis. 13 separate business lines running at over $100 million annualized, and management actually lowered and tightened expense guidance while absorbing 2 acquisitions. That's a strong signal on operating leverage. If my position has grown past my target size because of the year-to-date run, I'd rather trim through covered calls than just outright sell. That way I collect premium on the way to my target size instead of eating a taxable event. Adding to a full position up here doesn't excite me given how far it's already run, but if I got an 8 to 12% pullback tied to broad market noise rather than company-specific news, the fundamentals absolutely support me adding there. My default here is hold and only trim if the position got too big on me. If my covered calls were written before earnings, they took some damage on this move. If my strike is deep in the money now, my safer play is usually to let the shares get called away and re-enter through cash-secured puts at higher strikes with more flexibility. Rolling up and out only makes sense if I really believe another leg higher is coming. Otherwise, I'm just paying up to stay in a trade that already worked, and I'd rather reset the position cleanly. For any new covered calls I write here, I'm staying at least 10 to 15% out of the money on 30 to 45 day expirations. Management named specific catalysts like the social launch and prediction market volume that could each pop the stock 5 to 10%, and I don't want to cap that. Deep in the money, I let assign and reset with puts wider out. My LEAPS thesis is meaningfully stronger than it was 3 months ago. 13 diversified business lines at over 100 million annualized. International expansion is accelerating, and the company is running at a rule of 80 on over $5 billion of annual revenue. Any in the money LEAPS I own, I'm holding, not rolling. For new entries, I'd rather buy deep in the money January 2027 or January 2028 calls than reach for at the money strikes. The stock is elevated after the print, and I want delta exposure without paying peak volatility. The one thing that would make me rethink is a regulatory setback, especially on the Clarity Act or the perpetual futures approval. That would slow down the international and prediction market growth arcs that a lot of my thesis rests on. I hold my winners and add through deep in the money long-dated calls. If I'm underwater on this name from a higher entry earlier this year, this print doesn't change my thesis. It strengthens it. Customer adds accelerated, product velocity is compounding, and management tightened expense guidance while growing revenue 32%. There's no cut losses story here for me. For averaging down, the level that stands out is around $94, because that's the average price the company itself paid to repurchase shares this quarter. That's insider level information about what they thought was attractive, so that's my anchor. If I'm already profitable and just want to add, I'd rather wait for a 5 to 10% pullback than chase up here. The July net deposit softness and crypto weakness give the market a plausible excuse to retest lower before the next leg. For me, this is an average down setup around the 94 zone, not a moment to bail. Bottom line, this print earns a B+ from me. Robinhood is no longer a single product story, and this quarter is the clearest evidence yet that the flywheel is real. That's the grade, that's the read, and that's the video. Thanks for watching.